with Tom Hartman. I'm your host, Tom Hartman, for this November 4th, 2025. What a day it has been. Market down in all kinds of different ways. It feels like a lot, even though it isn't a lot, right? We had the S&P down 1.18%. We had NASDAQ down 2%, Bitcoin down 4.77%, which feels like a lot. And the dollar rose up something like 35 basis points. So, as it is with this new day and age, any sort of down day that's unexpected, especially if it moves on news or low liquidity, is seen as oh my God, the sky is falling. Totally understand that. We're still in bull market territory, and I assume we'll stay there until price action shows otherwise. But taken to Twitter, we will see quite a few discussions, actually, a lot more deeper discussions about what's going on with the shutdown and in crypto and in equities. All right, so the first clip here comes from, let's just hear a state of affairs of what Scott Bessent is saying. Secretary Treasury Scott Bessent is saying about the shutdown and that they need Democrats to come, reach across the aisle, and make a deal. But they're asking for the shutdown to be lifted first for the continuing resolution, I think it is, in order to allow the government to reopen and then talk about healthcare and all the stuff that they're interested in. Let's hear his pitch. Well, it's not really a pitch. He's speaking from the voice of the president. He's the hand of the king, speaking on behalf of Donald Trump on financial matters here to try to bully the public into pushing the politicians into doing what they need to be doing. Well, what he wants them to be doing.
I've called for 5 brave Democrats to come across the aisle. And, what's changed since we got the clean continuing resolution in the spring? 2 things. One, Senator Schumer's poll numbers, he's sinking like a stone. So we're being held hostage to his poll numbers. And then 2, the Democrats have tried to stop President Trump in the courts. It goes to SCOTUS, they get overruled. They've tried to stop President Trump in the mainstream media. That hasn't worked. So now they've shut down the government and they're harming the economy. So I think it would be great if 5 moderate Democrats became heroes, reopened the government, and for the entire shutdown, whether it's President Trump, Speaker Johnson, or Leader Thune, they've said reopen the government and we can have the conversation on health care, but we can't do it while the government's closed down. I've called.
All right, so the Democrats apparently are causing the shutdown to as a way of hurting Donald Trump. Okay, fine. I mean, every shutdown I've ever heard has been to hurt the political party who's in charge, and they're looking for heroes. I love that word, heroes, in order to reach across the aisle and make a deal. Right. All right. Well, good luck with that. We know there's a reasonable expectation to think that the shutdown won't continue, that they'll just wait until the pain is at a certain level, some concessions will be made, and then a deal will be struck. All right, next. This was a post from Thomas on markets that I really liked. Let's read about it. He says here, okay, lots of bad takes on X over the past. Oh, 1 second here, folks. Let me just set up the screen. All right. Okay. Lots of bad takes on X over the past few days, Thomas says. Is there a banking crisis? No. Is there a dollar funding crisis? Not really. Yet. Is the Fed doing QE? No. So what's going on? The current funding banking issues are largely being fueled by a rebuild of the Treasury General Account, TGA, the U.S. government's bank account at the Federal Reserve. This started in June after the government raised the debt ceiling. The target level for this TGA rebuild was $850 billion. So we had this rise of the TGA that happened. When cash moves from financial markets into the TGA at the Fed, it can be considered a liquidity drain because cash sitting idle in the TGA is essentially removed from markets. So a liquidity drain of roughly $700 billion. It also causes bank reserves to contract. And this is what has happened. Bank reserves have fallen to a multi-year low. shown here as a percentage of GDP. This contraction in liquidity within the banking system can cause stress in important dollar funded markets. We can see the stress through elevated SOFR, secured overnight financing rate levels, what banks pay to receive the financing that they need. So we have the reverse repo rate that has spiked up significantly. I would still characterize the recent SOFR spike as relatively minor, nowhere near what we saw in September 2019 of the repo crisis, which caused a meltdown within the banking system and forced the Federal Reserve to abruptly switch from QT to the QE. This was the Fed pivot during Vol McGinnon. And we've also seen some small scale take up of the Fed's standing repo facility by banks. This is essentially an overnight loan from the Fed to banks. $50 billion was tapped on Friday, October 31st. This shows that one entity or more than one entity did not have the liquidity it needs. This Fed facility is working exactly as intended. It's not QE. It's also not cumulative. It's an extremely short term, 24 hours cash injection and refreshes daily. I keep seeing people on X saying the Fed has pumped a total of X into markets in X days. This is not true. That's right. Anyway, none of this is a surprise. I've been writing about this for about 12 months now. I said bank reserves would fall to multi-year lows later in 2025. This has happened, where there would be minor dollar funding stress. This has happened, and the Fed would announce the end of QT before the end of the year. This has happened. This isn't me blowing my own trumpet. It's just was fairly obvious, and I wasn't the only one saying it. There are some not so obvious further issues that are exacerbating the current situation. Number one, if we look back at the TGA balance, you'll see that the TGA balance has risen past the target level of 850 billion. So we've seen roughly 150 billion more liquidity drained than expected. I think this is partly down to the ongoing government shutdown. Government not spending as much money, but still taking in the same amount of money, so money piles up in the TGA. And partly due to the fact that the Treasury has been auctioning a lot of new T-bills recently, with the proceeds landing in the TGA. Two, this is all coinciding with the end of month, October 31st. It's typical to see banks window dress their balance sheets on the last trading day of the month to meet regulatory requirements, usually achieving by moving cash into the Fed's reverse repo facility. And this is what we saw on Friday, October 31st, a normal end of the month spike in reverse repo usage, a temporary 50 billion liquidity drain. So to recap, an obvious tightening of dollar liquidity also coincided with the two other less obvious factors, which all added together to create some still relatively minor funding stress on October 31st. This is now dying down, as you would expect, with standing repo usage falling, SOFR levels falling, and reverse repo usage falling. If the TGA balance doesn't come down, liquidity injection issues will probably crop up again at the end of November, end of the month, and then again at the end of December, end of the quarter, probably getting progressively worse. It's clear that dollar liquidity is tightening and bank reserves are headed towards levels that could be considered scarce, bad. The Fed needs to stop QT, which they are doing on December 1st, which will largely stop downward pressure on bank reserves. I know the Fed will not immediately restart turbo QE again after that. Thank you for coming to my TED Talk. I fully expect somebody who knows more than I do to tell me where I'm wrong. I like that. It's a nice summary of what we've been talking about over the last few weeks. Obviously, we're picking the most salient posts on X that have really explained in useful detail what's been going on. We had that post, I believe it was last week. No, it was yesterday, talking about from Lynn Alden, and then also from Joseph Wang, who's also talking about these concerns. So it's to be expected, and I like the way that was articulated. All right, next up. This is a post from Raoul, who, whenever crypto goes down, because he's so bullish, irresponsibly long, and has gotten a lot of people to do that too through the "Don't F this up" slogan, where it's sort of like buy the dip or have fun staying poor. The idea is that you need to be holding crypto, a significant portion of crypto, in order to survive the debasement of the currency and to be able to maintain your wealth or build your wealth. And he sees this as the last time, the last chance that the average person will have. And after that, good luck. If you don't own any of these assets, you're going to be out of luck. At least that's his thesis. So when crypto markets fall significantly, as they did today, which is an ongoing drop that we've been having since the peak, and we're not reaching all-time highs at $250,000 per Bitcoin and all that sort of thing that we're expecting by year end, and that people are still calling for, he usually comes out to give a lot more context. So let's read this post here today. I know no one wants to hear bullish ideas and everyone is scared and wants to fling poo at each other, but the road to Valhalla is getting very close. If global liquidity is the single most dominant macro factor, then we must focus on that. Remember, the only game in town is rolling $10 trillion in debt. Everything else is a sideshow. This is the game of the next 12 months. Currently, the government shutdown has forced a sharp tightening of liquidity as the TGA builds up with nowhere to spend it, like we just saw from Thomson Markets. This is not offset by the ability to drain the reverse repo. It is drained, and QT drains it further. This is hidden markets in particular crypto, which is the most liquidity driven. TradFi asset managers have had one of their worst years of performance versus benchmark and are now having to chase markets, and that is allowing tech to be more stable than crypto, where we're seeing these run-ups in S&P and in Nasdaq, while Bitcoin has not achieved new all-time highs. So 401k flows help too. If this liquidity drain keeps going longer, stocks will get hit hard too. However, as soon as the government shutdown ends, the Treasury begins spending 250 billion to 350 billion in a couple of months. QT ends and the balance sheet technically expands. The dollar will likely begin to weaken again as liquidity begins to flow. Tariff negotiations will have largely been completed, removing uncertainty. Ongoing bill issuance increases, adding more liquidity via bank balance sheets and money market funds and stablecoins. Ongoing rate cuts, we will have economic weaknesses from the shutdown that will add to the evidence that rates need to come lower, but no, there is no recession. SLR changes free up more of the bank's balance sheets, allowing for credit expansion. The Clarity Act will get passed, given the crypto regs so desperately needed for large scale adoption by banks, asset managers, and businesses overall. The big beautiful bill then kicks in to goose the economy into the midterms. The entire system is now being geared towards a strong economy and strong market in 2026 for these elections. China will continue to expand its balance sheet. Japan will work to strengthen the yen and also fiscally stimulate. The ISM will rise as rates fall and tariff uncertainty drops away. You just need to get through the window of pain, and the liquidity flood lies ahead. Always remember the don't fuck this up rule and wait out the volatility. Drawdowns like this are commonplace in bull markets, and their job is to test your faith. Buy the F and dip if you can. TLDR, when this number goes up, all numbers go up. Total liquidity index. Interesting. So this is the bull case. Parts of it are in line with what we saw from Darius Dale last week, who was talking about the potential recovery in the economy, and the bullish sentiment that he has. This is making the case that if a lot of these dominoes fall, and the idea is that you just need the first ones to fall, the shutdown being over, liquidity being added to the markets, QT being ceased on December 1st, all these sort of things, that if they happen within a timely manner, we could see a bottom in soon. And if it doesn't, then we'll see stocks get hit, and that will just exacerbate the need for the fiscal and monetary policy to come in and save markets. So he's saying, hey, don't worry, just give it 12 months and we'll see. All right, this is a post here from TradingView 2, who was talking about something peculiar. I have to look more into this, but I thought this was pretty interesting. So he says here, nearly all the active sell pressure on BTC spot markets has come from Binance over the last 2 days. All of the markets are basically flat. Pretty odd to see. And here he has the cumulative volume delta indicator that's showing that it is the Binance exchange that is having all this net selling that's happening, not so much on the other exchanges. And when we read into the comments more, here it is here is aggregated CBD on top of 6 coins compared per exchange, clear outlier. So on the left side, we have spot CBD, and then on the right, we have the perpetual futures, where we do have selling that's happening on the other exchanges, but not nearly as much as we're seeing on Binance. Reading through the comments, the idea here is that the selling pressure that we're having is coming from somebody selling in on Binance specifically, that it's a systemic controlled selling event where massive amounts of Bitcoin are being sold through Binance. Where that stops, who knows? But it doesn't look like it's as widespread as it might seem, and supports the idea that we might get a bounce that's a healthy bounce once the main seller is done offloading. I know Peter Thiel was talking the other day about selling most of his position. I wonder if that's still ongoing, or if other people have taken up the mantle. All right, and that's it for the Daily Bread for today. We'll be back tomorrow with even more market news. Let's hope it's markets up. Well, I don't care. one way or another. With trading crypto and trading prop firms, whether markets can go up or go down doesn't bother me. I just want to be on the right side of the trade when it does. Markets will do what they do. It's for us to make that daily bread. Hey, we're getting close to a slogan. That sounded pretty good. All right, that's it, folks. Have a great night.